Today August 14th, 2023, we did get about a measure move up of the opening range, but there was something a bit more interesting. You see we went within about a tick of it and failed, which is pretty common. Generally, if you get within 1 to 2 ticks of measure moves, they sometimes fail. So if you're using them as profit targets, just probably put your limit order to exit a tick or two below where you would have previously. We also got about a 2 to 1 of the true risk of bar one, and I explain a little more on that concept. So you can buy above bar 69. It's a tight trading range, meaning it's probably about a 50-50 chance of breakout up or down, but it's the bottom of an overall trading range, and the spike leading into the trading range was bullish. Now, generally, if there's a spike up and then the bar could go sideways for 20 bars, after 20 bars, the probability is pretty close to 50-50, but it's still probably like 51 or 52% bulls since this was stronger. But generally, after 20 bars, the probability is pretty neutral. But, anyways, if you bought above 69, you're probably a bit disappointed in 70 because it wasn't able to close above the tight trading range. And so, if you think about 69, where would you have to have had your stop in order to not get stopped out? You would have had to have had it one tick below right here. Now, you don't know that going into the trade. Some traders will have their stop below 69, below 68, below 64, below 61, maybe even further. But true risk is the concept of, okay, you see after 70 that you would have had to have had your stop here because your risk went all the way from your entry price to here. And so what a lot of traders will do when they get a disappointing follow through bar on 70 is they'll look at what their true risk was and they'll take 2 to 1 of that and they'll scalp. So you can see here, traders, it's basically the minimum swing profit target after like disappointing follow through. So I consider it a bit more like scalping out of the trade, but that's what a lot of traders will do. And technically, if you bought above one, your stop, it would have had to have been one tick below four. So you go from, one to around that four high or that four low. And that's another basically the exact same as the opening range, 2 to 1 right up there. And I grabbed another example from yesterday too that makes some sense. So 27, if you bought above 27, which is a reasonable thing to do, you see you get disappointing follow through 28, 29, and your true risk is about 2 to 1 of that. And that's pretty much the top of where the bull spike was. There are other reasons why we turned down, like the 16 low where bulls got trapped, but it's just more reasons why there's resistance in this area. So there's something to keep in mind when you get disappointing follow through on a reasonable swing trade is that sometimes a lot of traders will scalp at 2 to 1 of their true risk. So bar one, bull bar, but you are at the bottom of a trading range from yesterday, and the day overall was probably going to be a little bit more bullish. I was thinking we might have to test above yesterday's high, which you can see, by the way, once we did break above yesterday's high, we had to come back and test it. That's pretty common when you break above important support or resistance. Bar two, micro double bottom. It's an inside bar. It's the same height as bar one, but probably more sellers than buyers. It's limit order trading right now. You're just kind of waiting to see what side gets trapped. Bull bar three, but not very strong. Sellers above two, probably buyers below three. So you can see any bulls who bought below three bought more at a new low on the day when we went below one and two because this isn't very strong. And we got a reversal up. A lot of those traders sold out around break even. Four, big bull bar, but bears will probably sell above four. So, not really that great. Bar five, bar four, big bear bar, bulls buy below, make money. Bar five, big bull bar, but bears are going to sell above and they'll probably make money. Wonder if we went enough for a scalp. Not quite. It's a bit of a smaller day though, so slightly smaller scalps are reasonable to expect, but still almost 40 range. Bar six is an inside bar. It's early in the day. You could look at this. Bears are looking at this as 3 pushes up and they're hoping to get a signal bar for a swing. Bulls are thinking that, they got a double bottom and they have an inside bar here and they want to go higher. Now, if you buy here, you kind of have to have a wide stop below four because sometimes you will get a bar that trades down here and then some sort of reversal up. So a lot of bulls will buy, and if we trade down here, they'll buy more lower, scale in, get it around break even. You don't get good follow through all that often, but it is early in the day, and sometimes early in the day you do get good follow through because you don't know how the day is going to form yet. Did we get a 2 to 1? I wonder if we did. Yeah, we still got there, but not quite exact. But anyways, like I was saying, inside bar on 6, an okay buy for a swing, but because you don't understand what the day is going to look like quite yet, so you can be more aggressive in the opening range, hoping this is the first leg. and you get follow through on 8, 9, and 10. Or sorry, 7, 8, and 9. But the thing to keep in mind is there are tails on the bottoms of these bars. There's tails on both sides of this bar. And while 9 is a big follow through bar, it's got a tail on the bottom and it looks climactic. And so my point in talking about the tails is just notice that there are pullbacks. This is a bull move, but there are pullbacks within the bull move. And it's easier to see on the 1 minute chart. So early in the day, where counter's all screwed up, but early in the day, you can see this was around where that trend was, and there are a lot of pullbacks in this channel. And those pullbacks, like I guess 8.4, 8.8, these are all these tails on the 5 minute chart. So while this looks like it's in the breakout phase, my point is this is probably in the channel phase. And while it's still okay to be long, you should be keeping that in mind and just be quicker to take profits. So when you get a climactic bar like bar 9, bigger than the rest, the past couple of bars, a lot of bulls look to take profits, and that's where we get 10. 11 touches the close of 9, and so any bulls who got the close of 9, disappointed 10, get out around break even. 12 is outside down, but not quite closing on its low. 13, follow through for the bulls. It's a low probability buy above 13, and you can see that. So if we get follow through, we might have trap bears, and that's in essence what low probability buys are. Follow through on 14, 15, 16, tails on 15, tails on 16, tail on 15, small bar on 16. I don't really want to be buying here. I think that it's a tight bull channel, yes, but it just hasn't done a lot of what I've wanted it to do. 17, bull bar closing near its high, but tail on the bottom. And it looks climactic. It's kind of two legs up if you think about it. 1, 2, pull back, 15, and then 16, 17 is the second leg. It's kind of hard to see, but the tail on 15 could be considered a pullback. And then you kind of see 16, 17 as a second leg trap. The whole thing could be a second leg trap from this, but it's just not. I'm having trouble vocalizing what I'm thinking, so I'll work on that because it just looks climactic to me. It's a really big bull bar after not a great bar, good bar but tail, good bar but tail, so not great, and then small bar and inside bar, and then big bull climax. So bulls take profits 18. Something to keep in mind is there's a 90% chance we break out of the 18 bar range. So while we might pull back here, it's more likely that we're going to break out up to this high, obviously, then go down to this low. So that's one of the reasons why we had to get above it on 28. 19, follow through for bears. 20, good bear bar, pull back, you can see on it. And then 21, bear bar. So you can essentially look at it as one leg down, pull back on the tail of 20. You can think of the tail of 20 as a bounce, and then a second leg down, 21. So it's 2 legs down. It's a tight bear channel. And the thing to keep in mind here is now that you have 4 straight bear bars, that should not be happening in a strong bull trend. I didn't really think this was a strong bull trend to begin with, but definitely after getting 4 straight bear bars, it's very much not a strong bear trend anymore. Sorry, not a strong bull trend. So that if we get above 18, which is likely because there's a 90% chance we're going to break out of the 18 bar range. So if we get above 18, you're probably going to find sellers because bears who sell above 18 are probably going to make money selling the top of the bear climax. 22, bull bar, but not closing near its high. We're probably going to get back to the 18 low since some bulls got trapped there. 23, bull bar, but I would rather this is strong enough to probably warrant a second leg down. And you could argue that the tail on 24 is the second leg down. So you start to get a second leg, but bulls know we're probably going up here, so a lot of them buy it, and you get 24. Potentially, though, bears will look at this as this is their spike, and then pull back, 2-legged correction, 24, 25, low too short, and some bears will take the sell for a swing, thinking we're going to at least get back down to the 12 high. You remember that anyone who sold above 12 disappointed a little bit in 13 and very disappointed in 14, and a lot of those traders needed to get out of break even. So that's kind of what happened on 35 here when we pulled back to that point. And so you could argue that the trading range essentially started at bar 12 because it really did. I thought that we were going to be in a trading range after this. And so while we did continue up, it was all just a part of what was a trading range. Generally, when you kind of get a pullback, when you get a bar that shouldn't happen, like bar 12, that's kind of a hint that the trading range might start. Sometimes it goes for a measured move up or even a little more. It's unusual for it to go this much more, I think, but usually when you get, start of a trading range like you do here on bar 12, sometimes you get a measured move up. So potential low 2, but bad follow through, 26. Some bulls buy above 26, looking to scalp to a new high. Get 27, not the best follow through, probably sellers at the 17 close, but a lot of magnets above. So I think we do have to go a little higher, which we do on 28, and get a reversal down 29. It's 2 legs up. It could be looked at as a wedge with the tail on 24. Potential sell below 29, but I think the bulls have been relatively strong. We're probably at the top of the trading range. And since there were the 4 straight bear bars from 18 to 21, it's probably okay to sell 31 or 29, but I think that this is just pretty tight and might deserve a second leg, so you got to be careful. Any bull who bought the close of 28, disappointed 29, exits during 30. You can see the tail on 30 touches the 28 close. 31, bull reversal, probably sellers if we get back to the 29 low, since some bulls got trapped there on 30. 32, a potential swing short. You could sell looking to get down to here, or maybe the 12 high. You have pretty reasonable risk reward if you do. And you get good follow through, 33. So some bulls trapped below 32. And then 34, we start to get below 22, where we should find buyers. And we touch that. We don't quite touch 12 high. You get a reversal up. So now it's 2 legs down, and you get a third leg down on 35, which touches the 12 high, letting those bears who sold and sold more higher out at break even, further confirming this is a trading range. And then 36, inside bar. It's 3 pushes down and a wedge to 36, but this is a pretty tight channel, so I don't want to buy just yet. 37 is a bad low one at the bottom of a bull channel, or sorry, at the bottom of trading range. And 38 is a reasonable double bottom buy for a swing up at the bottom of a trading range. I think one of the big keys with trading range days is figure out where traders are trapped and then look to use those spots as profit targets, because they generally get tested on trading range days. So you had trapped traders at the 17 close. So once you got decently far away from the 17 close, you knew that was going to be a magnet. Same thing with the 12 high. It's going to be a magnet. What were other ones? There wasn't a lot of trap traders today, but well, in my opinion, at least, I'm not great at this. So 38, double bottom buy. So, bulls get follow through. 39, 40, back in the middle of this trading range. There was the 31 low where there were some trap traders for sure. So some bulls will buy, just trying to make a quick scalp. 40, follow through, and it's 3 straight bull bars. But just as it becomes by the close, probably going to get a reversal. Because generally on trading range days, just as one side looks extremely strong, starts to look extremely strong, the market pulls back. You can see that happened on 41. 42, bull bar, but I'm not sure how much higher we're going. We're towards the top of the trading range. So if you are long here, you need to be really careful and quick to take profits. 43, 44, a couple of good bull bars, but I don't think we're going much higher. We're probably, even if we break out, we're probably going to fail because bears are going to sell above this, and they're definitely going to make money doing that. 45, bad follow through for bulls, and 46, second leg up. So if you bought above 44, disappointed 45, you can exit at break even during 46, and a lot of traders did that. Wedge top, 47. 47 is a reasonable swing short. Follow through, not ideal on 48, and then you get outside down on 49. So it's essentially a double top now. And, when you get this, it's pretty steep, and the bull channel was decently tight too. So it's kind of hard to want to take this short because it could just be 2 legs down and a correction in the bull channel. And it's reasonable to think we're going to get down here, but it just could go really sideways first, and you're probably going to get shaken out of your short. And that's kind of what happened. Is bull, it's hard to stay short above 50, 2 legs down, potential high 2s for a swing. But I guess it's lower probability, so it's okay to just stay short. But sometimes we can definitely bounce there, so it's just kind of hard. And then you end up getting a wedge bottom down here. So bad follow through, 50. Any bull who bought 50, disappointed 51, exits during 52. Another leg down for bears. 53, reversal up, but wedge bottom. Reversal up, wedge bottom, good for the bulls, but I don't think we're going much higher. And 54, it's follow through for the bulls, yes, but a big tail on the bottom, and it's not confirming for the bulls who bought above 53 that they made a good decision. 54 is, testing the 51 low, so we might find sellers, and big tail on the bottom. And, we're probably going to test the 53 high. It hasn't gotten far enough away that we're not likely to do that. Some bulls will take the buy above 54, but when they get disappointment 55, they're pretty quick to get out on 56, you can see. So it might be okay to buy above 54 since it closes above the moving average, but you are buying in the middle of a trading range. If you do buy it, you're hoping for essentially a measured move up of, this wedge maybe. Or maybe this wedge even. So you're just looking for a measured move up somewhere up here, which, we'll probably end up getting towards the end of the day. Yeah. 57, bad follow through and back towards the bottom of this bull channel. we're entering a tight trading range now. Pretty obvious, 58, 59, 60. Maybe if 60 closes better, you can buy it inside bar for a swing up, but we are in a tight trading range. 61, buyers below 60, buyers at a new low. See, there's going to be buyers here. 62, potential swing short, but probably going to get bad follow through. It's a trading range day, so you expect disappointment and deep pullbacks. And you get disappointment 63, and a lot of those traders who sold are very quick to get out during 64. 65, follow through. 66, inside bar. And, any bull who bought during 65, disappointed 66, gets out during 67. 68, probably buyers below 67. 69, we talked about, I think, tight trading range, good bull bar closing near its high. You could look at 64, 65 as a breakout because it did break out of the range by one tick. And then you get a two-legged correction. So a breakout pullback and then a buy above 69. I think it's an okay swing. Fall through 70, but a little bit disappointing, and fall through 71, but also very disappointing. So a couple ways to manage it. You could have a stop, a measured move down, but I'm not sure that's a great idea in trading ranges. Yeah, because those stops get run a lot. You can see it got run by one tick, and then we bounced. Follow through. So bears trapped above 73. When they see 74, a lot of them just exit above, and we get 75. Big climactic bar. Probably if you sold above, I haven't checked this yet, but probably I would assume if you sold above 73 and sold more on the close there, yeah, you can get out break even. 76, inside bar, just profit taking at the top of the trading range, probably buyers below, which there were. For always in, I think we were always in long, definitely by 7. Probably flipped to always in short on 21, but trading range. So a lot of times when it flips to always in short is right when you get a reversal. Same thing as it was probably back to always in long by 24, but definitely back to always in long by 28. And then we got a reversal. You could argue we went in always in short in here somewhere, but it's really difficult. And if we did go always in short, we're definitely back to always in long by 40. You could argue 49 made it always in short. Maybe 56, but it's kind of hard. And if it was always in short, definitely back to always in long by later in the day. But I think you could definitely make an argument that after we got the reversal up somewhere in here, it stayed always in long for the rest of the day because it's kind of hard bears were always one bar away. And that's what happens in trading range days is traders, if we get one more follow through bar on 34, it's always in short for the bears. And a lot of traders will bet against the always in position flipping on trading range days because traders, when they need that one more bar, they don't usually get it. What else did I want to talk about? Market cycle, I guess, is important. So we're in a tight channel. This is also a tight channel, and we got another couple tight channels, but it's ultimately tight bull channel into a trading range, which is expected out of these. These are tight channels more visibly on lower time frames, but on higher time frames, they're breakouts. So, like 950 to 1010 on the 15-minute chart. Oops, not the yearly chart. These are breakouts. They're strong bull bars closing near their highs. But I had one more thing I wanted to say. Not really. I guess daily chart, bulls got follow through. Some bulls will take the buy above this bar, hoping we get a swing back up. This is a tight bear channel, so this reversal is likely to be minor. 10 bars, 2 legs. So I think we might have to get back to this low, but I'm not super sure. This is a pretty tight channel. So this reversal, like I said, probably going to be minor. And, tomorrow is just going to be a really important day for the bulls. Are the bulls able to get big bull follow through closing near its high, or are they going to be disappointed? Yeah, that's today.